invested for a few years, and then you get a rebound. Okay, now, one pillar of the conventional left account is that the neoliberals come in, they increase the exploitation of workers, and as a result of this, the rate of profit rebounds. Well, I've been saying the rate of profit doesn't rebound. Okay? Well, it doesn't, but what they call the rate of profit rebounds. Okay? They have this thing that they call the current cost rate of profit. It's also based on this inclusive measure of profit, net value added minus compensation. At least this measure is based on that. Okay? This thing rises. This is 1980. Right here is 2007. So you do get a rise in this measure. Actually, from about 1984 onward, it's pretty flat, but there's a clear rise from about 82 to 84, and then you get that peak in 97. But what they call a rate of profit is what almost nobody else means by rate of profit. What almost everybody else, including myself, business people and so forth, mean by a rate of profit is profit as a percentage of the money that you've invested, the accumulated investment, or profit as a percentage of the book value, of your assets. That's what rate of profit means to almost everybody. That's not what this is. This is profit as a percentage of the amount of money it would currently cost to replace all of your capital assets. It means something entirely different. Okay? So they call it a rate of profit, and they say that the rate of profit rebounded. Okay. Now, you want to say that, fine. Nobody should think that it means that the rate of return on investment grows. They're actually not saying that the rate of return on investment grows. There is no real controversy. The rate of return on the amount of money that was actually invested did not rise. So there's no measurement issue. What we have is a conceptual difference between something called a rate of profit that most people call the rate of profit, the rate of return on the money actually invested, and there's a different concept. And this is a measure of a different concept. Okay? Profit is a percentage of what it would take now to currently replace all of your capital assets. Okay, a final pillar of the conventional left account is that the neoliberals came in, increased the exploitation of the U.S. workforce, and that's what led to the rise in the rate of profit and so forth. This was the thing that I found most surprising, because as late as 2009, I had bought a lot of this story. Let me try to find this here. Yeah. In 2009, I published a paper in Socialism and Democracy. And in this paper, I wrote, quote, "Profitability has been propped up by means of a decline in real wages for most U.S. workers." Okay, so I believed all of this. I thought that was an unambiguous fact. That's why I wrote it and allowed it to be published. I regret that now. So now I'm going to tell you the story of compensation in the United States the last 40 years or so. Okay, this is the profit share. It's the percentage of the output of corporations that the employees do not receive. From 47 to 1970, this profit share declined slightly, but almost all of the decline is from 1965 to 1970. Okay. From 1970 onward, if you forget the last couple of years, the thing is completely trendless. Okay? So the share of the U.S. corporations' output that goes to profits has been constant for 4 decades. The share that goes to the compensation of employees has been constant for 4 decades. Okay. Now, a few years ago, there was a graph published in Monthly Review by John Bellamy Foster and Harry Magdoff. Essentially the same thing is repeated in, the same graph appears in Enigma of Capital by David Harvey. Rick Wolf used the Foster and Magdoff graph as a basis of his analysis. And what is claimed is that the wages and salaries of U.S. workers have fallen as a percentage of GDP from about 52% of GDP in 1960, 53% in 1970, to about 46, 47% in 2007. This is technically correct. Okay? But when somebody sent me this Foster-Magdoff graph, and I said, okay, let me look at their data source. And I went to the table in the economic report of the president, and I saw this. I was absolutely dumbfounded because along with the column for wages and salaries, there's a column for the other components of employees' compensation and the other things I'm about to tell you. So when the table refers to wages and salaries, it does not mean this is what the workers receive. That's a component of what workers receive and a declining component. Okay? Here's other things from the same table. First of all, it's a mistake really to measure wages and salaries against GDP because that includes depreciation. The gross domestic product includes depreciation. Nobody receives the depreciation. So you should really base it on national income. This is wages and salaries as a percentage of national income, which excludes depreciation. Okay, basically gone down as well. But then workers also receive non-wage compensation. A lot of workers get retirement benefits from their companies, health benefits paid fully or mostly partly by companies. It's part of your total compensation. Its subjective utility might not be the same as $1 of cash, but that's not the issue. The issue is the corporations produce some output, income. Where do these dollars go? We're looking at the distribution of the dollars. Where are they going? They're not, if the workers are not getting them as wages and salaries, it's not because they're going to profit. They're going into the retirement funds of the workers. They're going into purchasing health care for them. And in addition, probably everybody knows this, a portion of your Social Security and Medicare taxes, if you're an employee, is paid by the employer. Okay? So that's also a portion of your total compensation. Okay? You add that in together with the wages and salaries, you get that kind of spaghetti-like line. Okay? Slight fall from 1970, but it's clearly higher than in 1960. Share of national income. But if you want to talk about the entire income of the working class, and this is what Foster and Magdoff do because they have this underconsumption story that income has been taken from the bottom and goes to the top, and the people at the top, they don't spend their income so much on goods and services. They buy financial assets and speculate in real estate and stuff. And if we had more income at the bottom, things would be better. Well, when we look at the net social benefits and we add them in, we're talking about the incomes of people really at the bottom. Okay? We're looking at unemployment insurance benefits, we're adding in welfare benefits, veterans benefits, and things like this. Believe me, people who are receiving unemployment insurance benefits are not speculating, on the stock market with that kind of money. Okay? So that is really the part of the total income of the working class. Okay? You add that in as well. The working class's share of national income is a good deal higher, even before the crisis, than in 1960. And from 1970, right here, to 2007, it's basically totally flat. Okay? So there has not been this falling share of workers' income. There has been an increase in inequality in this country. There is a real increase in inequality, but it's not due to corporations' profits going up as against the compensation of their employees, and it's not due to working people getting a smaller share of national income. Okay? There are a lot of distinctions that need to be made, and a lot of explanation perhaps to actually understand, and it's still not fully understood, why there's an increase in inequality in the sense of what has made the incomes more unequal. And income is, by the way, not just a unitary notion. There is no such thing as income that you can point to. You can measure it this way, that way, the other way. Okay. Now, people say, yeah, but the government's categories, when they talk about employees, they're talking about CEOs and managers and so forth, not only regular workers. That is correct. So in principle, it could be that the compensation of the employees has been constant as a share of the corporate output since 1970. That's possible that it's constant because regular workers' share is going down and the CEOs are getting so much and that's counterbalancing it. So I looked at that issue. Basically, that's not happening. There's been a slight increase in the share received by managers and such, and a slight fall in the share received by regular workers, but it's not huge. The figures, these come from a different source, also published by the government, the Bureau of Labor Statistics. They only go back to 1989. Some other figures I have tell a similar story. They go back to 85, 86. Okay, the dotted line is the real compensation, inflation-adjusted compensation of all civilian workers in the U.S. As a percentage of 1989 levels. Okay. The thick black line is the same measure just for people engaged in what they call management, business, and financial occupations. Okay, so a lot of managers and stuff included there. Okay, that rises somewhat more, but not hugely. Okay, there's really a gap from about 1994 through 2003. A gap develops, and then it sort of stabilizes after 2003. Okay, but in any case, the gap is not huge, and the people who are working in these occupations are less than 10% of the total. Okay, so when you net them out, they're getting slightly more of an increase, but there's only some of them. You get a very, very slight decline in the other workers' share of about 0.5 percentage point. It's nothing to write home about. Okay, just going to be very brief with these things. Here we have various measures of the hourly compensation, wages and salaries, plus retirement and medical benefits. They've all gone up since 1980. However you measure it, we take total compensation, you inflate in different ways. The real compensation of U.S. workers has gone up, not down. Okay. Here's wages and salaries. It's a somewhat different story, but basically, mostly the movement is upward as well. Next, please. Okay, now I'm not saying